Now we turn to Asia, and before I get into this, I'd like to remind you, please like, share, subscribe. We're going to talk a little bit about, the China. There's obviously they're in Lunar New Year, so there's not as much information coming out at the moment on the data side. But we're going to talk more about what we're seeing on high frequency data points in the EIA show, OPEC show. But we're going to look at Chinese data in general to look at what are spending, where is spending, what is going to happen in general. But before we get into that, I think it's important to highlight just the divide that continues to grow in China versus Taiwan. So this is looking at the individuals that identify as Taiwanese versus Chinese. And it's no surprise to see the increase where now about 67% of people within Taiwan identify as Taiwanese, and there's been a huge decline as those who identify as both Taiwanese and Chinese, and specifically the huge decline over the last, since essentially 92, of those that identify as Chinese. So again, this is the nationalism driving higher, which is going to make that one China policy so difficult in general, because Taiwan sees itself as its own nation, as its own identity, and they will not be willing to be absorbed back into China. Again, coming to how does this rectify itself? It won't be through some nice agreement of, oh yeah, we'll just come in within the Chinese fold and be a semi-autonomous nation. That just isn't in the cards, which is going to be something to watch as we've seen China get more aggressive against China based on what they've flown over the Taiwanese Strait. The U.S. has sent fleets through several naval fleets through the Taiwanese Strait to show those freedom of navigation movements. Again, these are going to be kind of that changing tide. As you can see, that huge drop off from 2018 to 2020 is going, and that, well, I should say, and the big increase from 2018 to 2020 is only going to continue to ratchet up. And there's little to see that changing, especially as the younger generation identifies as Taiwanese. Now, when we look at the Chinese structure, because Lunar New Year is disappointing to the downside, obviously no one's taking public transportation, even though that was something that was stable up until the very end of Lunar New Year travel in 2020. So you're going to get an additional slowdown from, essentially public transit doing nothing from start to finish. Then you have that we didn't really get a big spike in activity on the driving side. Instead, it kind of went flat, then went straight down. And the same has happened on airlines. So clearly there's going to be a lot of less travel. And what does that mean as people stay home? So this is looking at Chinese household spending in general. And when we look at that food, alcohol, and tobacco, which is about that 30%, we have to look at the food side, given the inflation that continues to increase, which is limiting the activity, that is going to hurt general activity and take away from some of those savings that these households have. Now, they're going to save on transportation, but when we look at the inflation of other things, especially housing in China, food and alcohol, and especially food in general, there's going to be this shift, because you're going to get a decline in transportation and you're going to get an increase in household spending in food. But none of that is really enough to spark the consumer or that dual circulation strategy that they're trying to push by incentivizing the local consumer to do more and spend more money, because there's still a lot of uncertainty in the market. Housing prices continue to go higher, which is leaving a lot of the younger generation in China behind. I think people in the U.S. can appreciate what that feels like. And you're starting to see this bifurcation. And again, it's, even though they want the consumer to get stronger, there's a limitation to how strong they can get, because they have pushed a lot of this debt down onto the consumer retail buyer, and obviously not to the same level as the U.S., just because they don't have that same type of capacity. But a large part of the Chinese debt bubble resides within China itself. And that's where you have to think about, well, what is the domino effect? And now that they've turned to the international markets and they've opened up their debt market to the international players, This is also moving some of that debt offshore as we continue to see a big increase in debt in bankruptcies on the offshore component, which we'll talk about in a minute. Then when we look at China GDP by sector, so in this one, we go back to Q1 of 2019 to get some of that normalcy. So you can see transportation is 4%. So what is the impact of people not traveling in the Lunar New Year? Well, let's be fair, it's not huge. But there's other components, which is industrial and construction. So when we look at industry, we've been talking about how margins are negative for rebar, for HRC steel, for other steel products. Export competition is increasing as prices are getting pushed up. Again, prices paid versus prices received. So when we look at industry and construction, that's where we start to see some of this pain in terms of what can GDP do, and why we keep looking at that export-import conundrum, and especially when we factor in China, given how weak a lot of those numbers were on the export and import side. And then when we look at that wholesale retail trade, that also remains an overarching problem, given where the wholesale retail trade, because when we look at inventories in general, they've started to normalize. So when we look at almost half of GDP growth in Q1 of 19, there is a lot of potential for hiccups, especially as the PBOC tries to pull debt out of the system, pull some liquidity out of the system, creating some of this strife that continues to be pushed throughout the different structures. Now, what has that done for interest rates? So when we look at yield to maturity, high yield credit indexes, the U.S. has continued to fall, as we talked about CCC, there's tightness in rates, where China's done the opposite. Chinese rates have gone up, not only because obviously the dollar has weakened a bit, but also because of the risk with the recent bankruptcies coming in, where people are starting to price in more risk into Chinese debt, which again has shown up in SHIBOR and other types of short-term debt ratios, which is why we keep talking about some of the different components of near-term debt cycles. Now, just pulling up SHIBOR at this point, you can see that there's, when we look at where SHIBOR 1 week is at 2.22, which is down from that peak that we saw when there was that shock at the beginning of February, which got to about 3.2%. But we're still elevated. We're still not back to where we were prior to it, and we're at the highs that we saw in 2020, which again is creating some of these problems. Now, given there's Lunar New Year, there's less people being active in the market because this is as of February 10th. So we haven't gotten that repricing yet. And this is why we're going to keep looking at what does that repricing look like as we go forward. And Jaguar Land Rover plans to cut 2,000 salaried jobs in next fiscal year. Not surprising given where some of these layoffs are. So now it's not Chinese Lunar New Year, which if you keep hearing me, I keep talking about Lunar New Year, because others within Asia celebrate it as well. So we have to look at other Asian nations to see what some of the impacts are. So here we start off with Japan. And you can see that the new COVID cases still remain elevated in general. Additional COVID deaths remain elevated. The lockdown index has remained flat at about 50%. That isn't going up or down based on, and it will last through next week. The bigger problem is that jobless concerns are going up, and cash concerns still have been fairly elevated, with activity in general getting a little bit better on the walking side. But you're still not getting this normalcy back into, because people are again tired of being locked up. So there's this bifurcation of when do we start to see some of this recovery, and we're going to start to see some of this Japanese pickup in general, just based on activity, even though we have jobless concerns and COVID cases that remain elevated overall. So when we think about the recent Japanese data points, we have to look at where did GDP close. So GDP came in at 3% versus an estimate of 2.4%. Quarter over quarter, 12.7% versus an estimate of 10.1%. Nominal came in at 2.5% versus an estimated of 1.9%. Again, all good things, but when we looked at how some of the issues closed out Q4, they started to close out fairly weak, which is why you started strong in October, November, and then finished December soft, and then that softness continued through Jan into Feb, which again leads to some of the issues that we see in Q1. Now, when we think about the inventory side, so business spending is the one that was up. That's starting to pare back a touch. As we look at industrial production and industrial month over month, year over year, some of these things are slowing down in general. So there's some good, some bad, but now we're going to have to look at what is happening on the import-export side, because that's going to be a good look into the future in general over the next few months. And just gonna look to see if anything was updated while we were filming this. I don't think it has been, but you never can tell, because data is hitting at all given times, especially the time delay. So here's an idea, and we cover it in a bit more detail. So this is all great, but what has happened recently? So exports in Japan. So exports were expected to be at 6.8%. They came in at 6.4%. Imports were expected to be down 5.5%. Instead they were down 9.5%. Now, I keep talking about this, and I'll talk about this again with Indonesia. We have to look at exports versus imports. Japan is an exporting nation. So they import semi-finished goods, raw materials, and they export finished goods. So with imports missing by that amount, that points to consumer softness and a future weakness of exports in general. So again, that's why even though industrial production was stronger into the end of last year, it continues to be soft through Q1, which again leads to additional slowdowns when we're thinking about how to factor in growth going forward. Now, when we shift over to India, you can see that the CPI inflation target has come back. The 12-month average still remains elevated, but we actually had a shift higher in some of the CPI expectations. It's still within the inflation target range, but that surprise spike over the last month has started to tamper some of what kind of stimulus can continue to go through. And again, even though we're going to get some fiscal stimulus, this is going to keep a lid on some of that monetary benefits that can actually get pushed through the system. Fiscal will still be there, and unless this really starts to overheat, which doesn't seem like it will in the very near term, but this will start to cap some of that monetary components that we've been talking about. Now, this is where we start looking at some of the Indian components. So here you can see CPI year over year came in slightly better than expected in January. What I'm talking about is what we've seen so far in Feb, which again is causing some of those adjustments in general. Industrial production is now up 1% as of January. That remains strong. Exports is up 6.2%. Imports up 2%. So again, this helps kind of prove the point that I was making with Japan. So when you look at imports in the prior month, they were up 7.6%, and exports were up 0.1%. This month, exports were up 6.2%. Again, imports are becoming exports, and we have to look at the connection. Now, given it's not one-to-one, there can be timing delays depending on what's being made, what are the new orders out there. It's just we have to look at the import level in general, and we're starting to see India get back to a bit more of a normal level in general. But that wholesale prices year over year, which again leading back to what we're speaking about with CPI and inflation, wholesale prices were expected to be up 1.14%. Instead, they were up 2.03%. Again, up that 2%. So that's why we remain concerned about, okay, well, we're still within that inflation target, but if we start pushing that top end, which is why I think we can expect fiscal, but not as much on the monetary side in the near term, just to let some of this cool off. But that industrial movement is a net positive, and we have to see that show up in the diesel market, because so far diesel demand still remains down year over year, while gasoline has seen some of those adjustments. And here's Japan, the Japanese data, in case you want to look at it as I described it previously, just to kind of put into a perspective the imports versus the export side. So that's why the imports have been down so much. And again, even though they were down 11.6% previously, and then exports were up 6.4%, It's just a matter of what is being made, what are those new orders, and here you can see core machine orders, going into the end of December were strong, and those had to be exported out, which we saw in Jan. But now what do we expect going forward? And that's where we continue to see this pain or this slowdown in economic activity in Japan. Now, when we look at external debt, because external debt as of who owns it, this is why we keep coming back to Argentina, Chile, and where some of this pain is. Now, Brazil has seen some of those inflation fears, but it doesn't have the same external debt. It's becoming a bit more of a problem. But the increase in inflation in some of these countries is sparking some of the concerns on inflation, debt, interest rates, and just what can be done to help cool down some of this spike in inflation that we're starting to see on the CPI level. Now, this is looking at India just to kind of, because we want to look at some of the different capacity, and this is why we're concerned or look at very closely what could inflation be. So India wholesale price index for manufactured goods is now at a high that we haven't seen going back several years at 5.1%. Now in 2018, it was about 4.5%, same in 2014. So now we're over 5% in manufactured goods. Now, wholesale price index for food articles has gone from that 8% down to about 3%, has gone down to a negative 2.8%. So that's a net positive. But again, as we keep talking about food inflation remains elevated. It's going to continue to push higher in general. But the manufactured goods side is also why there's some concern about where can inflation be, especially in India. Then when we look at defaults, when shifting over to China, defaults by dollar bonds of face value, you can see that over almost 7.5 billion was defaulted in 2020, and we're already at high levels in 2021, given the problems and just the size of the companies that have defaulted in general when we're looking at China, which is putting some of that pressure. Now, when we think about the credit impulses, so Barclays is saying that less credit is going to be created in January and February, which makes sense. I'm sorry, in February, because January we were showing something similar where we had a credit impulses coming down, but then at the last minute, you saw a huge push of credit, because every time China tries to pull credit out of the market, and by China I mean the PBOC and some of these provincial state-owned banks, you keep expecting this debt to fall, and then they turn around and get concerned when the economy's slowing or not going at the level that the CCP wants, and all of a sudden you get a huge surge of credit coming into the market. Now, the size of this means that we should get some of this reduction, but there's also a certain amount of capacity constraints, because obviously we are in Lunar New Year, so there is that holiday, which will limit some of the ability to get it out there, especially in Feb. But when we think about, if China is struggling, if China is seeing this reduction in exports, well, who's taking that capacity? And then this is when we look to Indonesia. So Indonesian exports came down a little bit, but still remain elevated at 12.24%. But imports were down pretty big at 6.5%. So again, the year-over-year side, where we expect some of these exports, speaking to some of the slowdown in global trade that we've been seeing and talking to over the last few weeks, is starting to show up with some of these import numbers, and it'll start to reverberate through the system. Now, when we think about that PPI inflation side of the equation in general, when we shift over to Asia, you can see kind of where those fears come in on that PPI component of what is going to be passed through, because we keep seeing this manufacturing goods, these commodities and processing, the prices keep going up, and this has to get passed through to the export market, because you can only subsidize your trade market so much before you're just damaging yourself to levels that you have to realize some sort of price increases. But while this is all happening, the U.S. dollar versus CNY continues to strengthen. The CNY continues to strengthen against the dollar, which has started to reverse today. So, my view is that the dollar continues to go up, but again, we're going to have to continue to watch this to see what kind of strength can come through. Then when we shift now over into the grains market, Chinese corn imports again surged to a new high in 2021. You can see where the forecasts are expected. And this is given due to the demand that we know is there. So we know that there's demand in China and there's a shortage, or there is they had to draw down reserves. So they have to refill reserves. And they've had a continuation of yields coming down overall, which we're seeing in Chinese corn acreage has declined since 2015. And this is what we talked about last week. They've already optimized capacity because you can only squeeze so much yield out of 1 acre, because after you reach this magic point of spacing and water and fertilizer, you can't do more of either without damaging total yield. So that's why when we've talked about getting to kind of this peak and now flatlining, this is where we continue to see these yields in general have declined, but yet stabilized at this level. So we don't expect too much up or down, but given the amounts to feed, the shortfalls on needing to feed feedstock, needing to replenish, this is becoming the bigger issue, which is why the imports are expected to be up. Now, this is also creating a problem when we take a look at what has happened in general, which is the harvest of soybeans in Mato Grosso. So when we look at Brazil, you can see harvest of soybeans in Mato Grosso last week advanced to 22% from 11% a week earlier. That is well behind last year of 58% and 45%. Again, delay of getting the harvest done and to port just means that you're going to have a delay on the, you're going to have rot because things are going to rot in the field. Brazil in general has a weaker supply chain, which causes a more than the global average of rot from crop to port. So again, these are issues that have to be considered. So we're already so low on the harvest side that this just means that there will be even less to be able to get into market. Again, maintaining a fairly tight market in general, which will keep prices elevated. And this is looking at corn. So corn planted was 21%, 63% a year ago, 47% on average. So this is the slowest pace in more than 5 years. Last week, Canob last week increased the national planted area outlook for this region due to strong prices, pace of sales, and recent favorable moisture, but bid expectations despite the later planting. So the longer it takes to plant, the more risk you have that the root system won't take before we get the onset of the dry season, which will be key in this area. And if you don't get it planting on time, that may reduce yields. So again, this is pointing to less supply in the market, which will tighten pricing and create those issues that we continue to see as U.S. net exports can, remain elevated. When we look at soybeans, when we look at pretty much across the board from wheat, corn, beans, exports remain to the upside. The trade estimates are to the left, and you can see that we've pretty much handedly beat all of those trade estimates with total year-over-year percent. Wheat is up 5%, corn is up 142%, and soybeans is up 81% year over year on our exports. Again, tight market, price increases, food security, food pricing, food inflation, all of this comes to the shortage as the U.S. continues to export. And at what point is there a nationalistic push to say, look, we need to make sure we have enough supply for ourselves. We have to make sure we have enough supply for our individuals. And again, the U.S. won't so much just because we do have a very broad base and we should have a bumper crop this year. But a lot of that is going into the international market, and there's tightness in other parts of the market, which is going to create this strife that, again, looking at on an international side. So I know we covered a lot. If you have any questions, please let us know. You can find me on Twitter. You can find me in the comment section, LinkedIn. It's always a pleasure to speak with people, get feedback. So tomorrow we have EIA. We're going to film the OPEC show, depending on when this can come out. It might come out Friday or Saturday, just in terms of timing, because we decided to do the Texas component first. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.